Welcome everyone to the first discussion video for Chapter 9, all about flex budgets. Before we get going on the new material, I wanted to ask a couple of kind of peek ahead questions, get you thinking about some things as we get started here. So first, in Chapter 8, we discussed the master budget process, or focused on the master budget process. The budgets that came out of that process would be considered our blank budgets as it relates to our extensions in Chapter 9 and beyond. So think about what you read about in Chapter 9. Look at the possible answers there and then come back for the solution here in a second. So the budgets that came into the master budget process would be considered our planning budget, right? Prepared at our expected level of activity prior to the period ever starting. Next up, in Chapter 8, we talked about the dual purpose nature of budgets for planning and controlling. As you read through Chapter 9, worked through your Learn Smart, whatever, which purpose did the creation of flex budgets seem to most closely support? Again, pause this, think about it for a second, and then come back for the solution. It kind of best fits with the controlling function. We're using these flex budgets primarily to reset or recalibrate expectations for purposes of performance evaluation. And we'll talk about that in more detail here as we go. So Chapter 9 was titled Flex Budgets and Performance Analysis. And your book had a helpful figure here on the variance analysis cycle that I think is always worth looking at. So we're starting in the bottom right here. And in that variance analysis cycle, the first thing we're going to do is put together a performance report based on our flex budgets, where we recalibrate those expectations and compare our recalibrated expectations to our actual performance, and we spit out these variances. From these variances, we're going to start to ask some questions. What went wrong? Right? Or what at least didn't go as expected or as planned. Hopefully we can identify some root causes for those differences, right? Those gaps between actual performance and expected performance. Take some actions based on the identification of those root causes to hopefully correct those things going forward. Then we'll conduct the next period's operation and do this thing all over again. Now, our first official learning objective in Chapter 9 then was to prepare a planning budget and a flex budget with one cost driver. So planning budgets, as I sort of alluded to earlier, are prepared for a single planned or expected level of activity. But as we can imagine, performance evaluation becomes really difficult if the actual activity level at which we operate, and activity level we're talking about volume, so production and sales, differs from that planned or expected level of activity. If we just take our planning budget and don't recalibrate these expectations based on the actual level of activity we operate at, we're not really comparing apples to apples. And that's what our flex budget really helps us overcome. So flex budgets, on the other hand, can be prepared for any activity level in that relevant range we spoke of back at the earlier part of our textbook. It can show costs that, quote unquote, should have been incurred at the actual level of activity. And this, again, recalibrates our expectations and allows us to make better apples to apples cost comparisons. Now, because of that, it should help managers better control costs, give them a better idea of where they stand in terms of gaps between actual performance and expected performance. And because of that, this last piece, it should improve the performance evaluation process. So I like to use this little Larry's Lawn Service example to illustrate some of these flex budget concepts. So I'll continue that through the notes here. So Larry's Lawn Service provides lawn care in a planned community where all the lawns are about the same size. At the end of May, Larry prepared his June budget based on mowing 500 lawns. That's his expected level of activity, in other words. Since all the lawns are about the same size, Larry felt the number of lawns mowed in a month would be the best way to measure overall activity for his business. So here's Larry's planning budget, and this kind of would be the output of the master budget process, that budgeted income statement in a sense. He's expecting to mow 500 lawns. He's expecting to charge $75 per lawn, so total revenue is expected at 75 times 500, or $37,500. He's got wages and salaries planned at $20,000. That looks like a mixed cost. A $5,000 salary, perhaps for Larry himself, a draw, plus about $30 per lawn and other wages. Then he's got some variable costs planned, gas and supplies, $9 a lawn, Equipment and maintenance, $3 per lawn. And then some fixed costs. Utilities, $1,000. Shop rent, $2,000. Depreciation on his equipment, $2,500. And insurance, about $1,000. So based on mowing 500 lawns, Larry expects his net operating income to be $5,000 here. Now let's say that Larry gets to the end of the month, tabulates all his receipts, checks all his logs, and he's mowed 550 lawns. Let's also assume that his revenue billed to customers totals $43,000, and his expenses, as shown here on the slide, wages and salaries $23,500, gas and supplies $5,100, all the way down through insurance at $1,200, total expenses of $36,550 for net income of $6,450. Now, if Larry takes his actual results and sticks them side by side with his planning budget, he can calculate some variances. So that's what's done right here, real quick. Actual revenue was $43,000. In the planning budget, that was expected at $37,500. So he has a variance of $5,500. And by the way, for any variance from here on out, we're going to determine whether it's favorable, abbreviated with an F, or unfavorable, abbreviated with a U. And that determination is made based on the sort of expectation versus the result from a profitability standpoint. So for any revenue item, if the result is greater than the expectation, that's favorable. If it's less than the expectation, that's unfavorable. And then the reverse would be true for any expense item. If the result is greater than the expectation, we'd say that's unfavorable. If it's less than the expectation, we'd say that's favorable. Right? Profitability would be more than expected. So we also have some variances here for wages and salaries. $3,500 unfavorable. Gas and supplies, $600 unfavorable. A couple small variances for maintenance and utilities, favorable for $250 respectively. And then a $200 unfavorable variance for insurance. So if we look all the way at the bottom line, from a net income standpoint, we have a $1,450 favorable variance. But the question then becomes, since these variances are favorable or unfavorable, does that mean Larry has done a poor job or a good job controlling costs? And if you look at sort of some of these expense line items, like for wages, $3,500 unfavorable, does that mean he's done a bad job at controlling costs? And vice versa for things like utilities, where we had a small favorable variance, does that mean he's done a good job controlling costs? And the answer is we don't know yet, or we can't say yet, because Larry had a higher level of activity, a greater level of activity than expected, right? He mowed 550 lawns as opposed to 500. So there's going to be some differences driven by that change in volume or activity that we have to account for first. And that's really where our flexible budget comes into play. So the better question would be, how much of these variances are due to this higher activity and how much are due to cost control? So let's think about a flex budget for Larry's scenario here. What we want to do then is take our revenue and cost formulas, our expectations about how those things move with activity, and flex total revenue and total expenses to account for this difference in activity between our actual level, 550 lawns for Larry, and our expected level, 500 lawns for Larry. So we'll just go line by line. So revenue, for example, Larry was going to charge about $75 per customer. So we'll flex that $75 times the actual number of lawns mowed of 550 to get a new flex budget number of $41,250 for revenue. We'll do the same for any expense that has a variable component. So wages and salaries, $5,000 plus $30 per lawn. So we'll do $5,000 plus $30 times 550 lawns for $21,500. Gas and supplies, $9 a lawn times 550 lawns, $4,950. Equipment maintenance, $3 per lawn times 550 lawns, or $1,650. Key point here, we do not flex any fixed expense, anything that does not have a variable piece. By definition, a fixed expense, right, should not move with activity, at least within some relevant range. So we're going to assume those are staying the same. It doesn't mean that's what we actually paid in a given period. Just means that's what our expectation was, that it shouldn't have moved with activity. So we've got utilities there at 1,000, rent at 2,000, depreciation 2,500, and insurance at 1,000. So all told here, we've got net income in this flex budget of 6,650. We're saying this is the recalibrated expectation about what net income should have been, given that we actually mowed 550 lawns rather than the 500 that were expected. Let's have a quick pause to do a quick practice here on this idea of flexing. So Buxton Framing's cost formula for its supplies is $1,350 per month plus $18 per frame. For June, the company planned for activity of 716 frames, but the actual level of activity was 713 frames. The actual supplies cost, so the receipts, what they spent basically, for the month was $14,820. The supplies cost in the flex budget for June would be closest to which of these numbers? So pause the video here, work through that, and then come back for the solution. That would be B, 14,184. We would take the fixed component of this supplies cost, 1,350, plus the variable component, $18 per frame, times the actual level of activity of 713 frames. So 1,350 plus the 713 times $18, and there's our 14,184. Now that we know sort of the fundamentals of flex budgets, we can hit learning objective 2 here, which is to calculate and interpret activity variances. So the punchline for activity variances is that they come about strictly because of a difference in the actual level of activity and our expected level of activity from that planning budget. So in Larry's example, we're talking about the difference between the 550 lawns that he actually mowed and the 500 lawns that he thought he'd be mowing in that period. Activity variance isolates the difference in total expense or revenue that's assumed to be driven by that difference in activity. So let's look at Larry's results here. Activity variances are going to be calculated by comparing the flex budget result for any line item to the planning budget result for the same line item. So in Larry's case, I've got the flex budget here in the middle and the original planning budget, one column next to it here, showing the difference in the number of lawns mowed, 500 expected versus 550 actually mowed. We've got the revenue and all the expense items there, and then net income. So taking the revenue line item, for example, the flex budget showed 41,250, saying that's what revenue should have been, given that we mowed 550 lawns. The planning budget showed $37,500 for an activity level of 500 lawns. That difference of $3,750 we'd say is a favorable activity variance for revenue because the flex budget revenue amount was higher than the planning budget revenue amount. Now, so far, we still haven't really said much about control of revenue and cost. What we're doing is isolating this difference that's caused strictly by this change in volume or activity from 500 lawns to 550. This doesn't mean we've done anything quote unquote good yet. Right? We're just saying based on this, the difference, 50 lawns times $75 per lawn, would drive a difference of $3,750 in revenue. Same idea for all the expense items that move with volume at all. So wages and salaries, we had $21,500 in the flex versus $20,000 in the planning. That's a difference of $1,500. We'd say that's an unfavorable variance for wages and salaries then. Unfavorable activity variance. It's also worth pointing out that the favorable or unfavorable nature of our variances here can actually be sort of predicted or forecast, if you will, just by looking at this difference in activity. In other words, in Larry's case, he mowed more lawns than expected. So the activity variances are definitely going to be favorable for revenue items and unfavorable for expense items. Okay, more activity should mean more revenue and higher costs, right? So this is not, again, saying anything about how we've controlled costs or revenue. Also worth noting here, as we mentioned before, we don't flex fixed expenses in the flex budget. So we're never going to have an activity variance for a fixed expense. Can't do it since we never flex them. So looking at Larry's bottom line here, net income $6,650 in the flex budget versus $5,000 in the planning budget, a difference of $1,650. Again, favorable because the flex budget amount's higher. We're just saying because of this change in activity, we would expect net income to increase by $1,650. And we note that activity and revenue increased by 10%, the 500 lawns versus the 550, but net income increases by more than that because we've got those fixed costs that kind of leverage some of that activity. And I'm going to stop this video here, revisit any portion you need, ask questions as needed, and then move on to the next one. We'll look at some different kinds of variances.